What if the dollars in your pocket feel heavier today, yet tomorrow they suddenly buy less breakfast, less fuel, and less peace of mind? Across kitchen tables, the April inflation headline of 2.3% sounds like a quiet sigh of relief, but beneath that calm figure churns a storm of shifting prices and a trade war chess match that threatens to tip the board. Regular unleaded may have slipped below last year's $3.62 high, and egg stickers finally look less scrambled, yet uncertainty has crept into every receipt. The Federal Reserve's target sits like a finish line at 2%, close enough to glimpse but still out of reach, especially with core inflation, stripped of food and energy, stuck at 2.8%. Meanwhile, President Trump's evolving tariff map redraws costs before companies can update spreadsheets, leaving shoppers, suppliers, and investors to navigate an economic terrain that changes overnight. This video dives straight into that tension, how a single percentage point can shape mortgage rates, retirement timelines, and the rhythm of entire industries, and asks whether the apparent cooldown is a genuine turning point or merely the eye of a larger price hurricane. Imagine fast-forwarding to the holidays only to discover that the turkey on your table costs 20% more because a new round of tariffs quietly roost on feed imports in October. Picture interest rates frozen at today's highs because the Fed dares not blink while headline numbers bounce like fireworks, 1 month subdued, the next reignited by container ships rerouted around retaliatory levies. Without a clear trend, CEOs postpone investment, small businesses hoard cash, and job openings thin out. In action, that decision to shrug at a low 2.3% could widen the gap between wages and living costs by spring. Your adjustable rate mortgage might reset above your raise, your credit card APR could climb while salary negotiations stall. History warns us, inflation that looks tame can re-accelerate fast. Think 1960 SIX's modest creep that became the 1970s spiral. Delay today and we risk replaying yesterday's mistakes on a modern scale. Need proof? Look back just 1 year. Eggs skyrocketed 70% before settling, families trimmed breakfast menus, bakeries ditching recipes built on affordability. Consider Midwestern firework distributors who, after a single tariff tweet, faced 25% surcharges on Chinese shells, forcing them to choose between doubling retail prices or canceling 4th of July shows. In border towns, retailers braced for retaliatory pork duties that erased razor-thin margins overnight. Even Wall Street's calm facade cracked in October's Tariff Tuesday when the S&P opened flat but closed down 3% after surprise levies on electronics components. These snapshots reveal how quickly optimism turns into cost-cutting, layoffs, or shuttered storefronts once policy shocks ripple through supply chains. The lesson: inflation isn't a distant macro chart, it's the price of school lunches, the viability of your neighborhood hardware store, and the return on the index fund in your 401k. So what can individuals do before the next surprise? First, lock in today's borrowing costs where possible. Fixed-rate refinancing or consolidating variable debt shields you if rates stay high longer. Second, audit your recurring expenses. Subscription creep often outpaces CPI. Third, favor diversified income streams, side projects, dividend stocks, or skills that translate across sectors because a tariff jolt in manufacturing can spill into services 2 quarters later. Finally, track forward-looking inflation indicators like break-even rates in treasury markets rather than headline reports that lag real-time shifts. Dear viewers, which everyday price spike, fuel, rent, groceries, hit you hardest this year, and how did you adapt? Share below so others can borrow your strategies. We read every comment, and your insight could spare another family the scramble you faced. Subscribers also get early alert explainers when policy headlines threaten fresh wallet pain, turning notification bells into economic smoke detectors that buy you time to act. Yet even armed with these defenses, a new problem looms. Yesterday's 90-day tariff pause is less a treaty and more a ticking clock. Businesses now face a compressed window to reprice catalogs, renegotiate suppliers, and hedge currency exposure, all while consumers interpret the lull as victory and loosen belts. If the tariff snapback lands in August, prices could spike into back-to-school shopping precisely when households are most budget-stretched. And if the Fed stays cautious, rate cuts may not arrive until late winter, prolonging high credit costs during the year's most expensive season. The danger isn't merely higher prices, it's volatility, the yo-yo that sabotages planning. Families push off car purchases, companies freeze hiring, and the economy's pulse slows, not from illness but from uncertainty about the next jolt. A fuller solution requires embracing agility at every level. Policymakers must coordinate tariff strategy with clear timelines, giving markets sight lines longer than a tweet. The Fed can publish scenario paths how it would react to varied tariff outcomes, so lenders price loans rationally rather than defensively. Businesses should map alternative supply chains now, even if it means slightly higher costs up front, to avoid catastrophic surcharges later. Households, meanwhile, can create an inflation buffer, stocking 3 months of essential non-perishables when prices dip, much like a financial emergency fund. Investors may shift part of portfolios into Treasury inflation-protected securities or commodity-linked assets that historically rise when consumer prices accelerate. Together, these moves don't eliminate inflation risk, but they convert it from an ambush into a managed obstacle that families and firms can budget around. Look further ahead. A disciplined tariff framework could eventually spur domestic manufacturing, creating jobs and easing reliance on fragile supply chains if paired with targeted subsidies and workforce training. Conversely, a retaliatory spiral could push effective consumer tariffs toward Yale's projected 17.8%, the highest since 1934, echoing Smoot-Hawley's role in deepening the Great Depression. In a best-case scenario, proactive households who locked fixed mortgage rates, diversified income, and kept emergency stockpiles will ride out the price waves and benefit from future industry reshoring. In a worst case, those who ignored early signals may face shrinking purchasing power and dwindling opportunity. Where you land depends on actions you take between headline calm and the next tariff tweet. This channel's future episodes will decode each policy pivot the moment it breaks, giving subscribers a tactical edge because in markets, knowledge bought a day early is worth more than analysis a week late. You've now seen how a seemingly mild 2.3% can mask a minefield and how decisive, informed choices turn that minefield into navigable ground. If this breakdown sharpened your strategy, consider subscribing so the next alert reaches you before the next price jump reaches your wallet. Until our next deep dive into the forces moving your money, stay curious, stay prepared, and goodbye.